Joining us now, Unlimited Funds, Bob Elliott. Bob, we've talked about regionals before in more strained times back in March. Western Alliance reported, sort of looking at that as a proxy for how the regionals are doing overall. What do you see?
Well, I see the basic picture that they've mostly weathered the storm. The difficult environment that happened really in the late first quarter and early second quarter is mostly starting to subside. You're starting to see those deposits rise. You're starting to actually see the financing costs and the deposit costs, which did elevate right after SVB. Those are now coming down actually late in the quarter. You see their endpoint deposit rate is actually lower than what the average was over the quarter. And what you're seeing is basically the credit situation is not so bad, right? Reasonable NIMs, decent credit situation, growing deposits. You know, if we hadn't been talking about SVB a few months ago, you'd say, yeah, pretty good quarter for these guys.
But it's been a mixed picture for the regionals overall, even though I will note the KRE is above 45, which has struggled to, it had a little bit of a rough day at some points today, but it's still, I think, like in the 46 range, which is great for the past 3 or 4 months or so. Is it safe to still get in here? How do you feel about that index overall?
Well, I think you're still at a price level that was not that much different than that Friday when SVB failed, right? And in fact, we were just talking a few minutes ago about how the move up just now this week has put us just a bit above how bad it was right after SVB. But still, in that circumstance, there was real concerns about a bank run, a broad bank run. There were real concerns about credit problems. There were questions about whether the Fed would provide the liquidity that was necessary at that time. And so we're seeing pricing that's in line with that circumstance in an environment where the Fed has shown what they're going to do, the FDIC has shown what they're going to do, and the deposit flight has, by and large, meaningfully reversed. About 60% of that deposit flight is now back into those banks. And so the pricing doesn't really align with the risk that actually exists on the fundamental side of those banks right now.
I mean, we've been talking about it, tightening credit. Just earlier this week, you had the New York Fed Credit Access Survey, showed a big spike in credit declines for things like auto loans. And then you just think about some of the other, like SLUs, things like that. I mean, have we seen the full impact of tightening lending standards, tightening credit, not only in the banks themselves with the earnings we've gotten so far, but in the economy more broadly?
Well, I think one of the key things to look at for credit is that a lot of that slowing that came from the rising interest rates actually happened in the second half of 2022. And so banks have been moderately extending credit over the course of 2023, but it hasn't been a big source of financing for many people through the course of this year yet. You see nominal growth continues to chug along. You see real growth. We're probably going to get another quarter of above 2% real GDP growth. And so that highlights the fact that it's not about a credit. This is not a credit-driven cycle the way we saw back in 08 and previous cycles. This is an income-driven cycle. When you have an income-driven cycle, that's what matters. That's why you got to focus on the labor market instead of solely focusing on the credit market.
So soft landing thesis makes sense here.
Well, I think the idea that we're going to continue to have economic momentum, absolutely. Now, the question is, can we get economic momentum and get that inflation to durably come down with a tight labor market? It's possible, but right now it's priced, particularly when you look at the bond market, priced in a way that is expecting that soft landing to happen. And that seems like a low possibility if you look through all history. It's very, very rare to get one of those soft landings. And so priced at a high probability of it relative to a low likelihood seems like, those short rate positions, selling short rates right now still look like a pretty good opportunity.
Got it.